So there we go. This is another question that we want to really look at and see what we can do in this particular case. So let's see the question we have here. So the requirement here is pretty simple. It says explain and show how this event will be reported in the financial statement of Delta for the year ended 30th September 2016. So like we mentioned, it is important to always understand the year ended 30th September 2016 because that will guide us on the various treatment that we need to do. So let's go then to the question and see what we need to do. Delta is an entity which which prepares financial statements to 30th September each year. Now, we've been told that already about the year ended of the company, so it's not something that we are new to or we have to be thinking about generally. The financial statement for the year ended 30th September 2016 are shortly to be authorized for issue. Okay. The following events are relevant to these financial statements. All right, so let's see what we have in respect of this particular scenario here. On 1st September 2016, now remember 1st September 2016 will be when? 1st September 2016 will be just the beginning of the last month for the year ended under review. Delta sold a product to customer X. Customer X is based in a country whose currency is the florin. And Delta has a large number of customers in that country to whom Delta sells similar products. The invoice price of the product was 500,000 florin. The terms of the sales gave the customer the right to return the product at any time in the 2-month period ending 31st October 2016. The sales price is $500,000. So that is the invoice price, 500,000 florins. 500,000 florins. Is it florins or florin? Okay, florins. Whatever that is. So that is the idea about that. Now, so the question we then ask ourselves is, how much revenue do we recognize in respect of this? Now, so this is why you got to be careful about this. Under IFRS 15, revenue from contract with customers, revenue is recognized when a performance obligation is what? Satisfied. So as per IFRS 15 guideline, since we have sold the goods to the customer, we are supposed to recognize revenue. But the customer has the right to return the goods if they have not sold it. So you got to understand that immediately we see a transaction like that, sales with a right to return, it means that there are two things we have to do. Number one, we need to recognize the revenue, and then we have to also recognize a refund liability. Stay with me carefully. The refund liability will be based on the best estimate of the entity on the probability of the goods being returned by the customer. So this is based on the best estimate of the entity on the probability of the goods being returned by the customer. So the sales value of 500,000 florins must be splitted into these two components. We need to recognize revenue component of it and then recognize the refund liability of it as well. Are you getting the treatment? Very important. Very important. So let's go back to the question then. On 1st September 2016, Delta estimated that there was 22% chance the product will be returned during the 2-month period. So on the date that they made the sales, the entity estimated that there is a 22% chance that the goods will be returned. Remember, I told you that the refund liability is based on the best estimate of the entity on the probability of the goods being returned by the customer. So at the date of the sales, which is the 1st September 2016, the entity has estimated that there is a 22% chance that the customer will return the goods. But let's continue to read. The product had not been returned to Delta by 15th of October 2016. Stay with me carefully. Our year ended is 30th September. So September, October. So it means that 2 weeks after the year end, the date on which financial statements are authorized for publication, the goods have still not been returned yet. But you got to be careful because the customer has a right to return the goods in 2 months' time. So at 15th of October, where we are authorizing the financial statement for publication, the customer still has about 15 days to return the goods if he so wishes. So you got to be careful here. Let's continue to read. On 15th October 2016, the directors estimated that there was an 8% chance the product will be returned before 31st October 2016. Oh. So what is this? This is events after the reporting period in accordance with IAS 10. And it's an adjusting event because it's an estimate. As at the reporting date, we have not concluded on the possibility of the goods being returned or not by the customer. So the day on which financial statements are being authorized for publication, the management have now estimated that there is an 8% chance that the goods will be returned. And so that is an adjusting event that will affect the way we have to recognize the revenue in our financial statement. What does that mean? It means that the invoice value of 500,000 florins, we have to recognize revenue and recognize the refund liability. So the amount recognizable as a refund liability will be the 8% of the invoice, right? And then the revenue will be 92% of the invoice. Does that make sense? You get the idea here? It goes back to the principle we explained here about when there is a sales with the right to return option. So that is the idea there. So let's see how we can then put the pieces together. The directors of Delta considered that most reliable method of measuring the prices for this transaction was to estimate any variable consideration using probability, that is expected value. Then we are given the exchange rates to use. So let's see what happens then. So what's going to happen is that on the date of the transaction, 2 florins equals $1. But because remember, the customer is in a country whose currency is the florin. So it means our company, Delta, their functional currency is going to be the US dollar, the US dollars. Okay, that will be their functional currency. So the date of the transaction, $1 is equal to 2 florins. So let's go. Now that we have done the workflow, let's go to Delta. And then let's bring in the initial recognition. So the amount to be recognized as revenue will be 92% of the 500,000 florins. Let's punch that out. 0.92, 500,000. That's 460,000 florins. Oh, I think I'm enjoying writing the zeros. 460,000 florins. But we are not done because company Delta is a dollar denominated. That's their functional currency. So we convert that into dollars using the exchange rate at the date of the transaction, which is 1st September, 2 florins to $1. So 1st September 2016. So if 2 florins equals $1, then 460,000 florins will be equal to how much? So what do? We divide. So we get a revenue recognizable in dollars. So that's going to be 460,000 divided by 2. And that is going to give us $230,000. Okay? $230,000. So the revenue to be recognized in respect of this transaction is $230,000. But remember we said the proceeds must be split between revenue and refund liability. So we get a refund liability, and that's going to be 8% of the 500,000 florins, and we'll divide that by 2, okay, so that we can get our answer coming up, because the exchange rate is 2, so we work it out straight. 0.08 by 500,000 divided by 2, and I'm getting $20,000. So this is how we split the revenue. But remember, we are not done, because if I ask you what is the journal entry, we didn't sell this for cash. If the customer has a right to return, then it looks like this is what? A credit sales. So really, we have to recognize debtors. So trade receivables will be the entire 500,000. So the 500,000 florins divided by 2 will give us $250,000. So journal entry on initial measurement, if you want to. Maybe let's take this to the next slide, so I don't have to squeeze my right up there. Will be to debit trade receivables with the entire figure of $250,000. All right. Then we will credit revenue with the 230,000. Then the balancing figure is what we are crediting to refund liability, which was the $20,000. Do you see it? So that is the initial measurement. Now, subsequent measurement. At the reporting date, which is the 30th September 2016, the debt is still outstanding, isn't it? So remember, the trade receivables is a monetary item. So what do? We have to translate that at the reporting date. So subsequent measurement, what's happening at the reporting date? That is 30th September 2016. So because the trade receivables is a monetary item, we have to translate it at the reporting date. Now remember, the person still owe us 500,000 florins. But at 30th September, what is the exchange rate? The exchange rate at 30th September now is 2.1 to a dollar. 2.1 to a dollar. So let's go. 2.1 florins to a dollar. So the person still owes us 500,000 florins. So how much will it be? So at the reporting date, trade receivables that will go on the face of the statement of financial position will be equal to 500,000 divided by 2.1. And so in dollars, what are we going to have in dollars? 500,000 divided by 2.1. Ooh, I'm getting something. 2380. $238,095 $238,095. That is the trade receivables at the reporting date. Stay with me. Stay with me. If you compare that to the figure at the beginning, what's happening? Because at the beginning, when the transaction occurred, the person is owing us $250, was to owe us $250. But at the end of the year, now the person owes us only $238.95. And so how much the person owes us has reduced because their currency has appreciated in value. And so that is going to be an exchange loss that will be recognized in the P&L account. Sounds good? That's going to be an exchange loss. So the 250,000 minus 238 and 95, what we got? 250,000 minus 238 and 95. Ooh, I'm getting 11,905, and that will go to the profit or loss account. Why is it a loss? Because trade receivables is an asset. Reduction in an asset is an expenses. You don't need a miracle for that. All right? Reduction in an asset is an expenses. So the person owed us 250,000. At the reporting date, their currency has appreciated in value, so they now owe us only 238.95. So there is a reduction in value of 11,905. That's the first thing we do. Second, now the revenue figure will be recognized in our financial statement, so nothing will happen. But still, at the reporting date, 30th September 2016, the refund liability has to also be recognized on the face of the statement of financial position under current liability. So what do? We have to translate the refund liability also at the reporting date so that we get a foreign exchange gain or loss, which will be brought in the P&L account. So refund liability that will go on the face of the statement of financial position will be, remember it's 8%, still 500,000 divided by 2.1 now, because at the reporting date, the exchange rate is now 2.1 to $1. So let's punch that out. Let's get the refund liability at the reporting date. 0.08, 500,000 divided by 2.1, and I'm getting 19,000 and maybe 48 approximately. So this is now the refund liability we have to recognize on the statement of financial position under current liability, because the person has 2 weeks to go, or we have 2 weeks to go, so it will be under current liability. But if you compare this figure to the initial figure we recognized, what has happened? The refund liability has also what? Reduced. Now, why are we doing this conversion? Because the refund liability is also a monetary item, right? That's why we are translating. Now, reduction in a liability is what? A gain. Okay, so we thought we owe them $20,000, but now at the reporting date we owe them only 19,048. So reduction in a liability is a gain. So that will give us an exchange gain that will be recognized in the P&L account. And so that will be the difference between the 20,000 and then 19 and 48. And that will give us an exchange gain of 19 and 48 minus 20,000. That's like, what the heck? $952. All right. So now that we finish with the workings, we can now extract our financial statement for the entity. But that's the workflow generally. That's the workflow generally. So delta, statement of profit or loss, for the year ended 30th September 2016. Now it's an extract, so just a few things will be in. We want to let the examiner know that. So we slash in the currency sign. First, we're going to bring the revenue, which we worked for earlier, the initial measurement bit. Got a revenue of 230,000. Okay, so that comes there, 230,000 for the revenue in that case. Then we bring in the other items that must come in the P&L account. The first one will be the exchange loss on the trade receivables, then the exchange gain on the refund liability. So exchange loss on trade receivables. Then we bring in the exchange gain on the refund liability. So this one was 952 and this one was 11905. That was a loss, so we put that in brackets. So this is a statement of profit or loss account in respect of this particular scenario. Then we go to the position, also an extract. So statement of financial position for the same year ended, but an extract as well. And then we bring it up for the period there. And we will have under current liability, current assets first. Under current assets, we'll bring in the trade receivables. And the translated closing figure, which was how much? 238 and 95. That is what will come. That's the current assets. Then under current liabilities, we'll bring in the refund liability. And we'll bring in the new figure, which is 19 and 48. This is the answer to the question. So let me pull up the last question here. There's another question here. Another interesting one. It says, explain and show how this event will be reported in the financial statement of Delta for the year ended 31st March 2018. Okay, so you can actually try your hands on this one.